What does it look like to invest 100% in an equity-based covered call ETF portfolio? Well, in this video, that's exactly what we're going to explore as I typically lift open the hood on this portfolio every couple months or so. So stick around for how income has grown, what the performance has been like, not just this year, but let's just do it all times as long as I've been able to track it. Let's also look at a portfolio that I'm building for a non-registered account as I've maxed out my TFSA. So many good things, and stick around to the very end because I got a big, massive, huge announcement, guys. It has to do with the sale of my condo, and so I'm going to flesh that out further at the end of the video if you want to stick around for that. Something I've talked about on this channel for the last 2 years, getting out of home ownership and into a rental. I'm probably the only person excited about this. So with that all being said, let's hit it. And of course, as always, we are diving into the CoveredCall ETF All-Star Tracker, which you can pick up in the description below if you like the info that you see here. But anyway, in one of the tabs is the Jordan portfolio. This is where you can see exactly what I'm invested in and how it's currently doing. And since you can see a lot of red over here, let's just say we're not doing as great as we were, say, last year towards the end of the year. Okay, so we're gonna just kind of move down the scale here as far as what's going on with this portfolio. So just keep in mind at the top is as far as what funds are in what accounts. The top is going to be my personal spousal RSP, or that's my personal RSP. The bottom one here, HOLD.U, is my wife's spousal RSP, and then everything in the middle that you see here, this is all my TFSA, which is officially maxed out. So we got a lot of yields here. That at the prices I bought them at, this is what you got. Now you can go out into the market now, and based on current distributions, which very well could end up being cut come May, it's obviously something as income investors focusing on cash flow we want fund managers to maintain. But with some of the decreases that we've seen, it's only kind of part and parcel for the volatility roller coaster ride that is income investing. So when markets rise, typically distributions will follow along, but if there's significant cuts, they can also follow in the other direction as well. But again, it's at the discretion of the fund manager and whatever kind of strategies that they can put into place to kind of say hold these distributions in place. But as the time of recording, this is the kinds of yields we're looking at, which, I mean, these are all record setting kinds of yields for each of these funds. Seeing almost 11% for BMAX is, again, unheard of. Almost 15% for HTAE. Usually that sits at like 10.5 to close to 11%, even HDIV at almost 12%. And everything else in here is a bit of a surprise as well. QQQY is the only fund in here without 25% leverage, and the fact that an unleveraged concentrated tech fund is reaching 19%, again, it's sort of unheard of for a fund like that. Let's move down as far as my price return is concerned. At the moment, with whatever distributions come in, I'm just going to average down some of the more beaten up positions. Now, I do have a proportionate allocation that I work towards, a target. So things like USCL, QQQY, QQCL, HYLD have a target weighting of about 20% in my TFSA, and then HDIV and BMAX are each at around 10%. So all these are kind of drifting ever so slightly. Overall, it's about 96% accurate. So it's still within the margin of very close, but I want to try to average the price down on some of these extremely beat up funds like HTAE and QQQY. I just did my taxes, so at least with HTAE, I could put in 10 grand, and there's only basically $7,250 in there. So my average return, if I put in that max, I could probably sink this down to, as an average, probably down to 13%, maybe. I'm just guessing, maybe somewhere between 10 and 13%. And then yeah, just gonna keep chucking some cash at QQQY to average that down. As far as total return, which as a reminder is price appreciation and it's your distributions included in one location, I'm still very much up on HYLD.U, double digits for HYLD and BMAX, and then rounding out the green is HDIV at 7.5%. Everything is still down a little bit, but these are also newer positions on my portfolio. I would expect HYLD.U to say have more growth in it. I've held it since August of 2023. HYLD, this guy I've held, it's been the warrior in my portfolio for the longest time. It's I've been riding with this fund ever since probably late 2022, and then BMAX and HDIV. Probably a year later, I invested in these ones, whereas HTAE up here, probably late 2024, I got into it. QQCL and USCL are pretty recent as of March, and then QQQY, again, fairly recent, last couple months. So not shocked that these ones are down, as I was buying at those times, right? They were highs. As far as projected distributions I can expect come May, this is what I'm looking at. It's down here. Hopefully you guys can see it. It'll be around $2,816. So that is a significant jump up from what I received in April, which was $2,581 roughly. Okay, so and then with the sale of my home come June, it's probably going to be close to about $4,000, I would imagine, at that point in time. Let's go into what a non-registered account is going to look like, since I'm getting into that now with my TFSA maxed out. But these are the funds I'm looking at occupying that space. It's going to be in my wife's name, as she doesn't earn an income. It's way more tax efficient if we do it that way. We could build out the portfolio, like double, triple the size, and she won't be hit by any taxes. But since my wife doesn't earn an income and I do, and if we're using money from the sale of our home, we just got to make sure that we are doing this correctly with the CRA. And maybe it is as straightforward as it sounds. Put some money in your wife's name, and that's all there is to it. But there are these things called attribution rules. And I only found out about this recently, but basically, if you're the higher income earner, you open, say an account for your spouse who maybe doesn't earn an income, and the CRA could determine that you, who are the income earner, the high income earner, put money there, and you could end up being the one getting taxed. Well, we don't want that. So in order to get around that, there is this income splitting strategy known as a spousal loan you could do. So basically, you set up an official contract, as I understand it. I haven't done it yet. Obviously, with stuff like this, you got to do your own research, talk to your tax professional when it comes to this, because I'm going to be doing that. But basically, as I understand it, you set up like an official document that says like you will loan your spouse this money. They got to pay a certain amount of interest, which is based on a CRA rate that they will that they determine every single year. Not sure what exactly that is at the moment. Haven't gotten that much deeper into that research, although I will need to with this cash becoming available. The time recording will probably within a week and a little bit. So if that's the case, set up an interest rate, and my wife would have to pay a portion of that interest every single month, or cumulatively at the end of the year. Can you add as you go along? I don't even know. I don't even know that. Like, can you just chuck more money in, or is it a set amount? That, again, I'm not too sure when it comes to that. But the last thing I want is a CRA looking at a non-registered account in my wife's name and looking at me and going, you were the one who put it there, so we're going to tax you. Because that's going to probably cost me in 2025 for this portfolio. It could very well cost me $4,000. And if I left it for a whole tax year, that's could be $4,000 to $6,000 somewhere in there. So I don't want to do that. The time to research that versus what I potentially could lose is quite high, so it's worth it to do that. But if some of you didn't know that, hopefully you find that useful. and I'll let you all know how that goes once I officially get into that for myself. But anyway, as far as tickers are concerned, I'm gonna do as a core position EQCL. I've owned it before. I want to own it again. And it invests in things like the NASDAQ, the S&P 500, emerging markets, developed markets, the Russell 2000, basically all the major indexes out there. So globally diversified with 25% leverage at a juicy 13.46%. Forward-looking yield, that's important to note, forward-looking yield. If the distributions were stable for a year, if you had that crystal ball and you were confident that these distributions won't be cut, then yeah, that's exactly the kind of yield you're going to be looking at this current unit price. So 50%, I'm going to do a couple of sector funds, Canadian sector funds right here. I'm using ENCL as a placeholder, and I really like ENCL, I do, but I'm going to stick with the suite of funds that Evolve has put out, so Bank, Utes, and their newest energy fund, Oily. Yeah, then I should expect around a similar yield to these ones as well. And then, so each of those will be about 10%. So I got 50 for EQCL. These three will occupy about 30%, 10% each. And then last but not least is going to be HHIS. I've talked about this fund before, maybe swapping out HYLD.U in my spousal account. I'm not going to do that. I've come to terms that, at least for me, and that's very important for me, HHIS is it's a curious fund. I see it more as a yield booster, complementary kind of fund just to have in this portfolio. So it's the kind of fund that I could see myself potentially either increasing in weight or suppressing. It's more of a I'll get into it and wait and see, but I still want it to be a long-term hold. Everything that I invest in, it's all meant to be a long-term hold. But of course, as new information comes out, as newer, potentially more efficient funds come out, then we'll see how that may interact inside of my portfolio. Now that we're outside of the CoveredCall ETF All-Star Tracker, we're now going to move over to this aggregator tool called Wealthica. And this is a good spot to see exactly how your portfolio is doing total return versus some of the other major indexes out there, like the NASDAQ and the Dow Jones and Canada's TSX 60 and the S&P 500. I really enjoy coming back to this tool, every once in a while just to see how my portfolio is doing against all these other indexes. Now, right now, it sits above the NASDAQ and a little bit below the S&P 500, but it actually works in reverse as well. So, I mean, from my experience with using this tool, which I've been using for the last 2 years, usually when it comes to down times, like the TSX and the Dow kind of rule the roost, like they're not down as much. But during the good times, it's usually I'm kind of right there neck and neck with the NASDAQ 100 and the S&P 500. So keep in mind what you're seeing here as far as performances are concerned. This is just year to date. It's total return, price appreciation, and distributions are included into this. My portfolio is the one that says all at 12 or negative 12.53%. No doubt some stuff on discount, which I'm going to be averaging down on as the year progresses, and if this is what we're to see for the rest of the year. As much as I like looking at the performance tab to see what my portfolio does against other indexes, the more important tab to me to be focused on here is for those cash flow income purposes, which is the income report tab here inside of Wealthica. And instead of looking at what's been going on with income growth year to date or even the back 12 months, I'd give you basically an all-time history of just how my income has grown basically since February of 2022. By that point, I had been invested for just a little over a year at that point, and I had just gotten into cover calls. It was probably my first steps into transitioning my portfolio from just single stocks and a couple of growth ETFs, and starting off with I think it was ZWC, that Canadian high dividend Canadian BMO ETF. But what you can see from February 2022 really to, I would say, July of 2023, so a good year and a little bit there, it was certainly a lot of just learning and trying to figure out exactly what I wanted. And I think the proof of that is right here. A lot of inconsistent distribution income. Some months it was way up, some months it was way down. A lot of that had to do with a fund I was into called XYLD. That was a really chaotic payer. It's an American covered call ETF by Global X. Sometimes it doesn't pay in a month, sometimes it pays twice in a month, sometimes it only pays once in a month. Well, by this point, I was getting really annoyed by that. I did not like that anymore. I wanted to stick with stable distributions that were not variable, and I wanted monthly payers. And so that became the predicate for the kind of consistency you see ever since basically September of 2023. Is really locking in exactly what I wanted. I had a much better refined idea of okay, what kind of growth I can expect. And honestly, through regular contributions every single month and reinvesting in natural distribution growth, it all culminated in this steady upward trend that you see here versus the other half of the chart, which is quite chaotic. But when you're new to investing or you're new to, say, covered call ETFs, I mean, some of you guys are going to get this a lot quicker than I did. And I would say even for the first, basically all of 2022, I wasn't really into the dialogue of covered call ETFs. I didn't see anybody that was really investing in this stuff until, of course, like I'm sure many of you out there, you found Adriano's content, and he's still going strong with that, and almost approaching 100,000 subs on his part. He's going to get that silver play button soon, so hopefully he pins that up in the background for his videos. Okay, so let's just kind of start at 2023 here in September. I had income of $1,446 as of April 2025. That's up to $2,586. When May comes around, that's going to be at around $2,816, which, given the time period, that's what, a year and 8 months, a year and 9 months. That's almost double. And then come June, that's going to be close to basically $4,000 at that point come June. From June, for the next year and 8 months, what can we expect then? This period of time has benefited from a lot of natural growth as well. So over the next couple years, I'm a little pessimistic that that's going to be the case, but it's a welcome bonus if we do see that. If it can essentially double in that period of time, what is the next 2 years going to hold? Even if it doesn't double, even if it's up like 50%, 60%, 70% by that point, I'm still happy and I'm still reinvesting and I'm still, contributing every single month to that. So it just goes to show when you start applying your education, you certainly will get more amplification out of that. And hopefully this serves as a good example for you all that it's not like even though I have a channel, it's not like I had this all figured out at the beginning. There was quite the learning curve over the first long while. I was also still very new to investing at the time. So imagine being new to investing, getting into single stock ETF or single stocks, I should say, some growth ETFs, learning how to evaluate companies, and then all of a sudden, making a switch to this income thing called covered call ETFs. It's been a blast. It's been an awesome ride so far, and especially interacting with all of you on the channel so far. So let this serve as an example of what you can accomplish when you get to work with your budget and a plan, and you have intent and you have interest, and you just stick with it, and look how it can grow over time. Don't let the numbers fool you. Right, back in February of 2022, that dividend was $31. Okay, so February 2022, which is then turned into $2,586. But everyone's situation is different. But the point is, just be consistent, stick with it, and you'll get with the language of this stuff. It comes. And for me, I can't say I had this burning interest at first for a lot of this stuff. It was cultivated over time. and that interest has certainly picked up with this channel. Last but not least, we are inside of Passiv in my TFSA. This is a great aggregator tool. I link it to your brokerage, read-only format, and basically what it does, based on these targets that you set, and if you have cash in there, it tells you what to buy. It'll never tell you what to sell. It'll just tell you kind of what to buy to get as close to your targeted allocation as possible. But then it, of course, tells you what this is the actual allocation that you have. And currently my TFSA is at 96% accuracy, so fairly accurate. But basically anytime money goes into this account, even though it's maxed out, anytime dividends roll in, as long as QQQY is down like 20% or anything more than that, I'm just buying QQQY for now. Just to average that down as best as possible. Everything else is kind of down 10%, 10 to 12%. So I want to make sure that I kind of shore up QQQY that much more, and then I'll focus on these other ones just to get them back to their targeted allocation. But basically everything is a 20% allocation minus BMAX and HDIV. This portfolio is designed to be American focused, growth driven, naturally growth driven, basically all-in-one core diversified ETFs, right? This kind of portfolio is, you could argue, it could be for beginners and it could be for a seasoned income investor as well. That's sort of how I look at it. Maybe the only side note here is this one sector fund, which is QQQY. HTAE occupied this place at one time, but I wanted more of the return coming through the distribution, so that's why I swapped it out. And that's why QQQY occupies this space. It's also more of a growth booster naturally. Again, it kind of sounds like an oxymoron when we talk about natural growth boosters inside a CoveredCall ETF portfolio. If you know a thing or two about these things, they cap upside. But having some concentration, of course, in the tech sphere, certainly more volatility, but can certainly help you out on the growth end of things. And when times are good, gives you flexibility to put some of those unrealized gains to use somewhere else. And that's what I've kind of been doing in this TFSA since I've facilitated this strategy. The spells are RSP, kind of boring. It's just one fund, HOLD.U, but it's the largest, it makes up the largest portion of all three accounts, probably about 37% of absolutely everything. There's the other version of HYLD I also have as well, which is probably like 13%. HYLD is basically half of my portfolio. But again, in time, within 2 years, that changes. HYLD will no longer have that kind of outsized impact on my portfolio. So Spells RSP, keeping it simple, HYLD.U, and it's been a beast for me in that portfolio. At one time, it was up like 20%. I had probably about $20,000 of unrealized gains, and then since the tariff stuff, that went down to nothing. So, and at the time when it was high, and I made that HHIS video talking about putting 100 grand into HHIS, it was for the reason of putting such huge unrealized gains to use, and I really actually did have about 100 grand in there at one time. It's probably like 82 or 83, something like that right now. Anyways, moving over to my personal RSP. Not much. This is a fairly small account. Well, for me anyway, $7,000, and it's just one fund in here. I'm not going to touch this, so I would rather it be more concentrated with more upside on the capital appreciation side. I'll still get a 10% distribution in there as well. And it's down like 25%. And since I just did my taxes, I could chuck like 10 grand into this. I could average down from like negative 25% to probably, under negative 12, which would be probably phenomenal. So we'll see about that. Yes, am I thinking about doing that? Of course. I still got the rest of 2025 to really figure that out, or at least maybe try to take advantage of some of these lower priced CoveredCall ETFs. So as I had mentioned at the top of the video, yes, I have sold my home. Many of you have been asking about this in the comments section, and whether it be one-on-ones or other mediums. For those of you who have been following the channel for a long time, but I'll do a bit of a recap for those who are newer. For the last 2 years, I've had this idea that, look, I'm disenchanted with home ownership. I live in Vancouver. It's, even if the market was to drop by 10%, 15%, although some people will naturally take advantage of that, I still see that as it's not adequate enough. For me and my wife, we've been living in a 2-bedroom condo. We did convert it to a 3-bedroom, turning our deck into a 3rd bedroom. So that's been what was once a short-term stay or meant to be a 3 to 4 year stay ended up being like 8 years. But our kids are getting big. We need to move up. I don't want to do it through home ownership, or else I'm going to be married to a mortgage. And that might be what everybody does. I do not want to do. I want to go a different route. I want to prove something differently, and that is going from home ownership actually to renting a place. And it's not about not owning something, because I'm just transferring the ownership from home ownership to equities. That's really where that transfer in ownership is happening. But I see much more flexibility with going that route, going into a rental. It's not as complex if I was to move, and I have much more choice in that way. But we moved up our timeline. We listed our place in February of this past year. A lot of that had to do with the tariff stuff. As soon as that became real, it was quite clear to me and my wife, this is going to scare the market. It'll spook it. So we better get a jump on this. And we did. We had to lower our price a couple of times, but we got to a spot where someone finally made an offer. We accepted it, and the turnaround time was like less than a month. And at the same token, as when we listed in February, we actually found a rental. We agreed to terms with the people that own the place. Nice people, awesome people, by the way, in a complex I really like. It's close to shops. It's a 4-bedroom, 3-bath townhouse, 1,800 square feet. We're going to be paying about $3,400 a month. Now, on that price, based on where you live in this country, depending whether you own or rent. If you're out somewhere rural, that could sound like totally crazy. But I live in Vancouver, and if you live in Toronto or Vancouver, then I know that you sympathize with the sentiment that, look, things are expensive. We got to do something different. And for us, I just want to port the equity from the sale of my place into CoveredCall ETFs and use that to offset the cost of a rental. So that's what I want to do. That's been the plan for the last couple of years. I've spoken about it a lot. And so I got to admit, though, it's going to be hard to like extract that income. I really do want to keep that going to work. What I might end up doing is just reinvesting that, and what I would normally contribute, I use that to offset that rental cost. So it's probably it's less complex that way if I do it like that. But anyway, that's just one idea I have in my head. There's certainly other things I gotta kind of straighten out before I get to that point. Tremendous value. Even the amenities building is insane, and I want to do like a full tour of like the place I came from, the place we're moving to, just more of like a lifestyle piece that I can add to this channel, just to show what you can actually get. Anyway, the amenities building is like, it's got a pool, a hot tub, a fitness room, a yoga room, it's got a bar, it's got a pool table, tennis table, a conference room, it's got a big huge movie theater, it's got a floor hockey rink. This place is crazy. The complex is so huge that they've hired one person to just take care of the amenities building. Like, the amenities building is just massive. It's got its own like mechanical rooms. It's got all kinds of stuff in there. So I'll be thrilled to share all that with you all. It's going to be it'll be a bit of a change, but it's going to be a good change. I'm so excited about doing that and sharing that experience, and sharing an angle of talking about home ownership. You can probably expect a little bit more content that way when it comes to just owning a condo for 8 years and then going to a rental. And really, my costs don't change. I mean, that was the whole point. Take the equity out of my current place, put it to work to offset the rental cost. And as it turns out, nothing is really going to change as far as like what I shell out for mortgage and strata and all these other things associated with home ownership into a rental. And I get double the square footage. I get an awesome amenities building. I've already met parents and other kids, that my kids who are 8, 6, and 2, that they can now play with. It's a massive complex, super close to like restaurants and like stuff that we're like my wife and I can shop at. It's awesome. I cannot wait for this, and this will certainly be, I mean, who knows what kind of long-term stay with that is, but at least for the near term, this is where we're going to be calling home, and really looking forward to that and sharing more details with all of you. So with all that being said, hopefully you enjoyed the update. Hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.